Hello there and welcome to our webinar on financial planning for business owners. We'll just take another minute to allow other people to log on. We have a large attendance today. It's obviously a subject close to many business owners' hearts. So let's begin. My name is Andrea Patterson. I'm the Financial Planning Manager here at the Amergin Group. I'm delighted to be here alongside Conor McGowan, the Managing Director of the Amergin Group and an experienced business advisor. Conor is a chartered accountant with over 20 years of client guiding expertise, specialising in strategic planning and helping business owners to achieve their personal and corporate financial goals. With a strong background in senior executive roles at Microsoft, PepsiCo and leadership positions at JP Morgan Corporate Finance, Procter & Gamble and PwC, Conor brings a wealth of knowledge to help businesses and individuals succeed. Don't miss this opportunity to learn from Conor's vast experience and gain valuable insights into achieving financial success.
Thanks, Andrea, and welcome everyone. Thank you for taking time out of your day to be with us. I am confident that it will be time well spent. We've seen a considerable increase in the amount of work that we are doing with our clients in this area, and we're getting a lot of queries via LinkedIn and other social media. So we felt it would be timely to prepare a presentation to give people a better insight. Andrea is going to give you a brief top-line review of the importance of personal financial planning for business owners, and with the small change to today's agenda, our focus will be more on the tax-saving opportunities that can be achieved as you transfer your business. So back over to you, Andrea.
Financial planning is the process of taking a comprehensive look at your financial situation and building a financial plan to reach your goal. As a result, financial planning often delves into multiple areas of finance, including investing, taxes, savings, retirement, your estate, insurances and more. Financial planning life cycle can be represented by capital accumulation phase, which may peak in 50s or 60s, followed by a gradual capital drawdown. There are typically 4 financial stages. When you're in your 20s to 30s, the financial need at this stage may be dominated by a need to fund a home purchase. Savings tend to be short term. When you're in your mid-30s to 40s, at this stage, people's income may increase. Family responsibilities may also increase. Savings and investments start to lengthen. Long-term savings plan for children's education and saving for a pension. Surplus income starts to increase. When you're in your 50s to 60s, investment and retirement tends to dominate. More focus is put on retirement. Clients may inherit funds from their parents and look for the best options for investments. Surplus income is at its peak. Retirement normally starts from 60 onwards. This is when your earned income stops and is replaced by a pension. The state pension currently commences at the age of 66, but it will need to be topped up by a private pension. You can start to draw down your private pension from 50 onwards, depending on the type of pension you have, and of course the funds you have accumulated in your pension pot. As a business owner, you dedicate countless hours and immense effort to build your company's success. However, it's crucial not to overlook your personal financial well-being. Building sustainable wealth and achieving financial success is a shared objective we strive here at Amergin on behalf of our clients. While working together, our experienced chartered accountant and financial planners possess the expertise to develop personalised wealth building strategies for business owners. We leverage our knowledge of tax efficient wealth extraction methods, investments, opportunities and risk management techniques to help you achieve your financial goals.
Thanks again, Andrea. As successful entrepreneurs, you'll understand the importance of strategic decision making. But it's crucial too that your business planning includes actions that address your own retirement. So today, I'll explore the unique considerations and opportunities that are available to maximize savings, minimize tax liabilities, and ensure a very smooth transition. We'll explore some valuable insights and action steps to secure your financial future. That said, it is an area that is very specific to each business and each individual, and so in preparing for your own retirement, you should engage with your accountants, your tax advisors, your financial planners to ensure that you design a plan that's unique to you. Okay, that said, let's take a look now further into the world of retirement planning for business owners. One quick slide by way of context. To secure a basic living of just €26,000 in retirement, and bear in mind that our years in retirement now are much longer than past generations, would require a pension pot of €900,000. You are, I'm sure, well aware that we've got very poor pension coverage in Ireland, but what isn't always immediately obvious is that even those who have a pension are seriously underfunded, with an average pension pot of just €84,550 per person. So look, despite that somewhat frightening picture, the good news is that for business owners, comprehensive and holistic retirement planning can result in some very generous tax-efficient pension funding. The start point in any planning process is to undertake a holistic tax planning review to examine the current company or group structure. The purpose of that review is to check how the structure impacts on pension and tax outgoings, on claims and on future tax reliefs, and on potential tax efficiencies when it comes to retirement or sale, or indeed any other future exit from the business, and really to review if there are any tax planning opportunities that are being missed. So among the merits of carrying out the tax planning review is to identify any low-hanging fruit. Are there any tax planning opportunities that are easy to implement, or tax reliefs that might be immediately obvious that we could action? So, exit strategies, transferring your business within your lifetime. The objective of today's presentation is to explore those exit strategies and options for business owners who are retiring, selling a business, or otherwise transitioning wealth in 2003. The main tax reliefs are as listed here, and the focus today is on the first three reliefs and their combination. So how those reliefs interact does dictate on how we might exit a business tax efficiently, and the potential savings that can be achieved, indeed to the pitfalls that need to be avoided. So looking at the first then, why would business owners put a holding company in place? Well, the rationale for incorporating a holding company to own shares in the trading company and any other new investment assets through that holding company would be to give potential to sell shares in that trading company in the future tax-free. Albeit, of course, as always is the case with these things, there are plenty of terms and conditions to secure that tax exemption. Nonetheless, it does facilitate a structure for holding excess trading profits separate from the trading business to allow for opportunities that present themselves also. So, for example, investment in other trading ventures that are separate to the trade of the company, and indeed perhaps, as I said, to allow excess funds to be accumulated for future retirement instead of suffering personal income tax on all profits and earnings. Let's look at that in a bit more detail. So what are the holding company capital gains tax exemption benefits? In summary, a holding company can sell an EU-traded subsidiary company without capital gains tax, when normally capital CGT would be at 33%. So in other words, the proceeds are tax-free. Incredible. Not surprisingly, there are conditions. The investor company must be a parent company of the investee company for a continuous period, effectively of 12 months prior to the sale. The trading company must be tax resident in a relevant territory, which essentially means an EU member state, or a territory with which Ireland has a double taxation treaty in force, so that would include the UK. There's a trading requirement, which means that at the time of the sale of the shares in the operating company, trading profits and trading assets are tested to see if the company is wholly or mainly trading. And that really means wholly or mainly really means more than 50%. So there are certain circumstances and transactions where the exemption does not apply, and they're not all that relevant generally speaking, but an example would be the sale of shares in a life business or a life assurance company, something of that nature. Not surprisingly, there are certain anti-avoidance conditions that potentially could apply as well. But look, let's take a look at a very quick example that may help illustrate the benefits. So the background to the group is that Emer and Charles are 50% shareholders and working directors, both in their late 40s. The EC Holdco / EC Opco group structure has been in place for more than 5 years. It is a chartered surveying consultancy with an annual turnover of €975,000. Each has been taking fairly minimal salaries from the operating company, and Emer and Charles have now decided to sell the business. They've accepted an offer for the shares in the Opco in the amount of 4.5 mil. The EC whole company now is going to sell the shares in the Opco to a third-party Irish chartered surveying group. Let's call them CSG Limited. And so now, what are the tax implications for the EC hold company? Well, assuming the conditions that we outlined earlier are met, then the whole company will qualify for a capital gains exemption. And quite incredible, really, that would be the case. But just to note that the value of the shares at the date of the sale will be dependent on the market value of the company at that point, and that's a very important one to note. If instead the shares in the operating company had been held directly by Emer and Charles, then the capital gains tax on the sale of the shares would apply, and the transaction would then maybe be subject to entrepreneurs relief and maybe retirement relief, and we're going to go on and examine those now. So retirement relief. Retirement relief is relatively straightforward to understand, and again is probably best explained by way of an example. So Eric has an operating company, he's full-time working director, he's age 61, he owns 100% of the share capital in the operating company for over 30 years, and now he's decided to sell the business to a competitor with a view to retirement. He's accepted an offer for the shares in the amount of €700,000, and that will result in a capital gain of €600,000 to Eric. And he's wondering, how could he or will he qualify for capital gains tax retirement relief on the disposal of the shares? Anyway, before considering the availability of the relief, the balance sheet and the assets of the trading company, the Opco, must be reviewed to identify what are termed chargeable business assets, because only chargeable business assets will meet the conditions. So again, what are those conditions? The requirements are as follows. It's only available to an individual who must be aged 55 years, at least. There must be a disposal of what are termed qualifying assets, and those qualifying assets must have been owned for a qualifying period. What's the meaning of a qualifying asset? Well, a qualifying asset of an individual is a chargeable business asset of that individual, which really broadly means the business assets of the individual and the shares in his or her family company. So what are chargeable business assets? Chargeable business assets are assets that including the goodwill of the business of the individual, where the assets are used for the purpose of either farming, a trade, a profession, an office, or an employment carried on by that individual or by that individual's company. So certain assets are excluded. That's important to note. Shares or other securities like quoted shares, or other assets which are held as investments, perhaps property assets, or that's primarily it, or other assets where no gain would accrue in any case. So the CGT retirement relief on those chargeable assets introduces the concept of a family company test. So that would need to be met by Eric in this instance, given that his business is held in the form of shares in a private trading company. So that family company test, then what is it? Essentially, it's a shareholding requirement. And so in determining a family company, an individual must either hold at least 25% of the voting rights of the share capital of the company, or at least 10% of the voting rights, as long as the other family members hold at least 75% of those voting rights. The shares in the family company must be held for a period of at least 10 years, ending with the sale. And there's also a full-time working director requirement test. Okay, so what does that mean? It means, bear with me a second, just pull up the detail here. So the working director test means that he must be a director for at least 10 years prior to the disposal. He must have been a full-time working director for at least 5 years out of that 10-year period. And a full-time working director is a director who was required to devote substantially the whole of their time to the service of the company in either a managerial or technical capacity. So for Eric to potentially qualify for capital gains tax retirement relief on the sale of the shares in his operating company, the following requirements are also required. So the shares must have been, there's the share timing test, they must be owned for greater than 10 years. They must be there is a trading requirement. So as I said, the company must be wholly or mainly trading for at least 10 years ending with the disposal. There's a commerciality test. So the relief is only available to a disposal where it is made for genuine commercial reasons and where its sole or main purpose is not the avoidance of tax. Okay, so there are all the terms and conditions. And so what's the quantum then of the potential tax relief available to him in the instance where he has a claim for the CGT retirement relief? So there are really two. So the transfer of a sale or the transfer of shares or a sale to a child, there's no limit if the parent is under 66 years of age, and there's a €3 million limit if the parent is over 66 years of age. Where there is a transfer of shares or a sale of shares to a third party buyer, that limit is substantially less. So if Eric was under 66, as he is in this case, for the transfer, a 750,000 limit applies. Where he is over 66, had he been over 66, a €500,000 limit would apply. So let's look at an example that may illustrate for us. I mentioned earlier that the first step would be to analyse the chargeable business assets of the Eric OpCo for the purpose of the relief, and the proportion of the consideration on disposal of the Eric OpCo attributable to the disposal of the chargeable business assets is in this instance €680,000 divided by 730 multiplied by the sales proceeds of 700,000, so that gives us a result of 652,000 odd euro. So we can see then that the 750,000 euro threshold, which would apply to Eric in this instance, is not exceeded, and so we can get full relief for that 652,000 euro. So the gain qualifying for the relief is 558,904 euro. So that is the gain of 600,000, but multiplied by the 652 proceeds that are allowed, divided by the total proceeds of 700,000 euro, which gives us 558,904 euro. So how would that operate then? So the CGT retirement relief for Eric as follows. So he has the full relief because he hasn't exceeded the 750,000 threshold. So the tax relief can be reduced to zero. Now in this case, a small amount of the proceeds attributable are to non-qualifying assets, and they are subject to CGT, and you can see the small amount of CGT that is applicable there. Just a small note, lifetime limits do apply, so previous transactions can count towards the lifetime limits, and also the annual CGT exemption that we all enjoy, modest as it is, of €1,270, does not apply where there is a simultaneous claim for retirement relief. You can't get both, in other words. Okay, that's retirement relief. So what is entrepreneur relief? You may have heard of it. And what does that allow us? First of all, it's now kind of referred to as revised. It was revised, so it's revised retirement relief. And when would it apply? Well, if retirement relief was not available, for example, due to the age requirement that we mentioned earlier, then a claim for entrepreneurial relief or entrepreneur relief may be available to Eric on the basis of the sale, subject to meeting some relevant conditions. So what are they? Just to point out very quickly that the conditions that were that had been in place were amended in recent years, and there are differences. So the relief originally introduced a rate of 20% on disposal of qualifying business assets, and that was subsequently reduced to 10%. But in any case, for Eric to qualify for the entrepreneur relief in this instance, he would have to meet the following requirements: a length of ownership test, a share ownership test, a qualifying business and a group requirement test, and a working director employee test. So they're slightly different in some instances, so let's look at them in more detail. The length of ownership test: the individual must be the owner of the shares for any 3-year continuous period before disposal. Previously, those qualifying business assets must have been owned for a continuous period of 3 years in the 5 years immediately before the sale, but that change came into effect in January of 2021. So a slight change there that should be noted. There is a share ownership test. So Eric needed to own at least 5% of the ordinary shares in the company. The qualifying business requirement is where the business is one other than the holding of securities or other investment assets. So also it couldn't be involved in the holding of development land or letting of said land. A qualifying group is a group where each business, where the business of each 51% subsidiary consists wholly or mainly of carrying on a qualifying business. And important to note that a group where there is a dormant or non-trading company will not qualify for the relief. So again, pre-planning in that regard is required. The working director or employee test, pretty straightforward. The individual must have been a director or an employee of the qualifying company or companies in the group and required to spend not less than 50% of their time in the service of the company. Again, in a managerial or technical capacity, and must have served in that capacity for a continuous period of 3 years, within the 5 years prior to the sale. Okay, so again, let's look at the relief that would apply. So the relief that could apply, assuming you met all the conditions, would be that the first €1 million of capital gains are subject to a 10% capital gains tax rate, and the balance of those then of the capital gains is taxable at the normal 33% capital gains tax rate. So, you know, it is definitely the case that entrepreneurs relief is a very viable alternative to a retirement relief claim, especially where not all the conditions that are necessary for retirement relief are met. I would like to just point out that a claim for entrepreneur relief must always be considered carefully within the context of any future tax planning or future retirement planning, because it has potential interaction with retirement relief claims. So we're going to look at that in a little bit more detail shortly. So here's an example to illustrate retirement relief. We have much the same conditions as before for Eric. Let me just pop it down here so I can see it. So assuming the conditions are met, as we said before, then the revised entrepreneur relief would operate as follows for Eric. We'll assume the same values as we had in the retirement relief example. We did mention that there is a ceiling on the proceeds when it comes to entrepreneur's relief. So only the first €1 million of proceeds can benefit. So with full entrepreneur relief, the tax liability on that 1 million is reduced. But it's important to note that there are lifetime limits that apply here as well. You can see there that with entrepreneur relief, no tax applies, just that minimum 10% on the gain, which is 60k. If the entrepreneur relief was not available, then that CGT capital gains tax would be 198,000. So very, very significant saving there. CGT retirement relief versus CGT entrepreneurial relief, and what is the difference between the two reliefs? So entrepreneurial relief reduces the CGT rate on a gain of up to $1 million to 10%. Retirement relief relieves the CGT arising on a gain up to certain thresholds. So the difference there between reducing and completely relieving. The minimum ownership period is different too, in that the ownership period for retirement relief is 10 years, whereas that for entrepreneur relief is just 3. The minimum percentage holding for retirement relief is 25% or 10% where at least 75% of the shares are held by the family. The minimum percentage holding for entrepreneurial relief is 5%. Both reliefs have mandatory application to the sale and transfer of assets, and in practice, and this in practice can be quite a potential pitfall, because it is possible that some individuals could use their lifetime thresholds for both reliefs in the same transaction with no net benefit for doing so. So that is a big watch out for your tax advisor or your financial planner in your application for this relief. Just be careful about that one. But look, in this instance, in this example, let's assume that the conditions for both reliefs are met, and Roger, who is age 60, sells 100% of his shares in his trading business for 1.5 mil. We can assume a nil cost base for CGT, and all assets are qualifying. And you can see there the result, the comparison and the result. And in this instance, retirement relief is more beneficial, albeit with a modest enough saving in tax. Let's look at another example here. So here Jerome is 57. He's owned an opco for 16 years. The business has been successful. He's now ready to exit, and the business is worth 5 million euro. He wants to gift 70% of the business to his son Tom, who's been trained to take over the business since he graduated from college, and he wants to sell the remaining 30% of the business to Marjorie. She is someone who Jerome believes will be a key asset to assist Tom in driving growth in the business going forward. So we'll assume that all conditions for both retirement relief and entrepreneurial relief have been met, and just here we're going to illustrate that the timing of those transfers really will determine how those reliefs will apply. Let's assume there's no minority discount for the value of the shares, just for illustrative purpose in this instance. So he's got a couple of options. So option one, and again this is about timing. Option one, he sells 30% to Margaret first and then gifts 70% to Tom. In that instance, he claims entrepreneurial relief on the 1.2 million gain arising on the sale of the shares to Margaret, so her percentage. That's a 1.2 million gain. And the CGT rate is 10% on the first million euro and 33% tax on the remaining 200, which is 66. And so the total amount payable there by John would be by Jerome rather, would be 166,000 euro. CGT would apply on his gift of shares to Tom, but retirement relief would relieve that tax, and therefore the total CGT payable by Jerome on this 4 million euro transaction would be 166,000. Option two, however, is where we Jerome gifts 70% to Tom and then sells 30% to Margaret. So Jerome can claim a full CGT retirement relief on the gift to Tom, but as he has sold chargeable business assets, he has used up his 1 million euro lifetime limit for entrepreneurial relief. And that's because the CGT entrepreneurial relief has operated to charge the first million euro of his gain on the gift to Tom at 10%, irrespective of the fact that the gain was exempt by retirement relief. And so therefore, the 1.2 million euro gain on the sale of his shares to Margaret will be fully chargeable at 33%, leaving a tax bill of 396,000 on this transaction. So if the reliefs had been used correctly and the timing was right, Jerome could have saved 230,000 euro. So that's a really very important point, and I thought worth noting separately. Okay, moving on. What's the exit structure then in 2023, right? So, they say the day you buy is the day you sell. So if a future exit can be planned carefully in terms of getting the structure correct from the outset, the end result can be very different. So what is that optimum structure then? Well, everything is very personal, of course, this is a general illustration, I guess, but a hybrid structure allows both for a claim for a holding company exemption at the same time as a claim for either retirement relief or entrepreneurial relief, again, subject to conditions being met, but also allow for some appropriate salary and pension planning to be incorporated into that hybrid structure to maximize all available reliefs. So it really is, I think, giving you the best of all worlds. It allows the client to roll up, or allows you as a business owner, I guess, to roll up part of your sales proceeds into a holding company, maybe for reinvestment as well, instead of losing 33% to tax, while at the same time receiving part of the sales proceeds personally. So this might be a really good start point for discussion with your tax advisor and your financial planner in determining, in preparation for your ultimate retirement. I referenced there very quickly some pension planning, and it really is, I see Andrea giving me a hurry up sign, so I better quickly move through this one. So retirement planning and tax planning absolutely encompasses the crucial aspects of pension planning. And so, I would suggest to me, it's very important to seek out specialist guidance for pensions. And you can see there some of the great advantages from a tax perspective of doing some pension planning for individuals and indeed for directors. So you can get marginal relief at 40%. We're probably all very familiar with that for contributions as individuals. The companies have the potential to benefit from a corporation tax deduction for contributions that the company might make on a director's behalf. Throughout the pension's lifespan, that fund has the opportunity to grow entirely tax-free. I'm sure many of you are very familiar with these. Upon retirement, you have the ability as an individual to take a tax-free lump sum up to €200,000. And then the next €350,000 is at the lower tax rate. If the pension fund isn't retired, in other words, isn't taken advantage, it can be passed on to a spouse tax-free under the estate. So if you die before taking your pension, it can be passed tax-free to your spouse. And you can read on and so on and so forth there. Sorry, Andrea, just 2 seconds more. For individuals, there are personal limits and contributions. 46-year-old earning €150,000 per annum will be restricted to putting only €28,750 into a pension annually. A 51-year-old, the limits on contributions are slightly higher. So a 51-year-old earning €150,000 per annum would be restricted to €34,500 into a pension annually. Of course, you can contribute more, but the tax benefits stop at that point. Far better for directors. There is far more flexibility in reduced, even for funding purposes, and indeed a proprietary director, so somebody who owns 15% or more of shares in the company, has much greater flexibility to reduce salary and then maybe replace that reduced salary with employer pension contributions. There are calculations carried out to determine the ultimate fund that can be achieved, but really the above can result in some very, very generous tax-efficient company pension funding, which, by the way, can also include the spouse if the spouse is working in the company as a director and receiving salary. There's an example there of Paul, and to compare where he has no personal pension or company pension scheme in place, an average salary of 121,000. I'm really getting the hurry up from Andrea here, so I leave you to look at that again. And we'll come back to that, I think, probably in more detail in a future webinar if people are interested. We can make a few more case studies that can illustrate the benefits of pre-retirement pension planning. There are other options as well for future exit extraction, termination payments, indeed share buyback as well. So if you're to step back from all of this, we've looked at the the benefits of putting a holding company structure in place. We've looked at retirement relief. We've looked at entrepreneurial relief. We've looked at a combination of both. We've examined the hybrid structure, which probably is the optimum. We've touched on transfer of your business or pre-retirement pension planning, where you can fund your pension significantly before you retire. That's absolutely a fundamental part of this type of planning. And I think we'll come back to that in a later webinar. I just want to close very quickly, because we haven't touched on it, and again, maybe it's subject to a future webinar, to talk about succession planning. So what happens upon death with our estate? Again, in the same way that we've explored significant tax savings associated with the transfer of your business at retirement, there are very significant tax opportunities and savings that can be made where we do some advanced planning in relation to our estate. You can see some of the areas that will be reviewed in that context, and I think we might bring, often you see solicitors who are very specialists in this area. We may bring somebody in the future to talk to us a bit more about that. I leave it there for today. I apologise if I've run over time, Andrea, at that. But thank you for your time, everybody. If you have any questions or concerns, or you want any further guidance, don't hesitate to reach out. I'm sure our contact details are available to you. So thank you very much indeed for your time and your attention. And back to you, Andrea.
No problem, Conor. Sorry we ran over time today and we couldn't cover everything on our agenda, but don't worry, we'll be revisiting these topics in next month's webinar. I can see there's a lot of questions here on the chat, which we'll answer by email in the coming weeks. Thanks again for joining us today. And remember, a secure financial future doesn't just happen, it is planned.